So issue of debentures. Question number 1. This issue of debenture is similar to issue of shares only. Okay. Wherever you use a share, now you replace with the debentures. That's you replace with debenture. 10,000 5% debentures, face value 100 were issued for 110, including premium, and the issue price collected 40 for application, including premium, and 70 for allotment. So 100 rupees, but issue price being 110, collection amount being 40 with application, so 30 plus 10, and another 70 is along with allotment. What is the journal entry for the application money? Yeah, so bank account debit to, rather than share application, it is debenture application. Debenture application. The value being 40 rupees into 10,000. Come on, tell me the value. 4 lakhs. Okay, good. The next entry being it is transferred to debenture. So debenture application account debit to 5% debenture. Better you use a rate of debenture as a prefix to the debenture. The value is 4 lakhs. But for the debenture, it is only 30 rupees, right? So 30 into 10,000, 3 lakhs. Another 1 lakh will be named as the securities premium. Clear? Now, what is the journal entry for the due entry? Means allotment. Due entry for allotment being, come on, copy that. Work out the illustration. Others. What is the journal entry? Debenture allotment account debit. Yeah, to 5% debentures. No, securities premium is already collected there. So 70 into 10,000, 7 lakhs. Due entry is passed. Now collection entry. Bank account debit. Yeah, to 5%. Sorry, debenture allotment account. Debenture allotment. That value being 7 lakhs. Clear? Finish up copying. The topic is very simple. With respect to the issue of debenture, there is no any complication. It is similar to the thing what we have learned in share issue is replicated here. Try the next illustration. Come on, make it faster. Question number 2. Usually, equity shares cannot be issued at a discount, but debenture can be issued at discount. In case of securities premium, that will be credited. In case of discount on issue of shares, that can be debited. In this illustration, 10,000 5% debentures, face value 100, issued for 90. 100 rupees debenture issued for 90. After discount and the issue price is collected 40 for application and 50 for allotment. If nothing stated, securities premium or discount will be adjusted with the allotment only. Is that clear? 50 plus 10. Now come on, pass the journal entry for the application. The entry for the application is the usual entry. Very simple. Come on. So bank account debit 2 debenture application, the value being 40 into 10,000, 4 lakhs. Then this debenture application is transferred to where? Yeah, 5%, 5% debentures. The value being 4 lakhs, 4 lakhs. Now what is the due entry for allotment? Debenture allotment account debit to 5% debenture. The amount recoverable for 5% debenture being 50 rupees, so 5 lakhs. But the amount credited to debenture account being 60 rupees per debenture. 60 into 10,000, 6 lakhs. You collect 1 lakh lesser here. If you are collecting 1 lakh higher than the securities premium, here you are collecting 1 lakh lesser. Then that will be discount. So, debenture discount. Debenture discount or discount on issue of debenture being 1 lakh. Hope you will be now able to understand how do we handle this one. And next entry being the collection entry, bank account debit to debenture allotment. Debenture allotment. This value being 5 lakhs. Next. So these kinds of journal entries are pretty rare. And what sort of entry you can expect is this one. Question number 3. Question number 3 like. Okay. So you have to understand how to pass entry for these kinds. Face value of the debenture being 100. The issue price of the debenture can be 100 means at par, or issue at 120 means issue at premium. Maybe we can issue at a discount also. These are the 3 chances are there. Apart from that, you have to understand that these debentures are supposed to be redeemable few years later. We cannot issue irredeemable debenture. Share capital can be issued for the lifetime, non-redeemable. Okay, but in case of debenture, it should be redeemable matter of 5 years or 10 years or 20 years later. You have to intimate by what time you are going to redeem. Redeem means cancel the debenture. I issue the debenture and collect the money. 5 years later, I pay the money and collect the debenture and cancel the debenture. That is called a redemption. Okay, you understand what is the meaning of redemption? Cancelling the redemption. It's paying the debt. Paying the debt. 5 years, 10 years later, if I supposed to pay or pay back that, I may pay back the same 100 rupees or redeemable price. This is called a redeemable price. I can redeem simply at the same value, 100 rupees. What does it mean? I issue at par, redeem at par. Or issue at premium, redeem at par. Issue at discount, redeem at par. If you buy the share debenture by paying 90 rupees, 10 years later you will get 100 rupees. Meanwhile, in these 10 years you will be getting the interest year after year. You don't get the dividend, but you will get interest year after year or periodically, probably 6 months once or whatever it may be as per the terms of agreement. Interest is payable. Interest is payable. Is that okay? By the 10th year, you surrender the debenture and get 100 rupees back. Sometimes, in order to motivate the investors to invest more, the company may issue for 100, but stating that while redemption, buying back, I will pay 120. It means redemption at premium. Redemption at premium. Understand? So redemption at par and redemption at premium also be possible. So if you buy the debenture for 100 rupees, 10 years later you will be getting 120 rupees. Meanwhile, over the 10 years period, you are getting interest also. So year on year, you are getting interest. And the nth period, you are getting 120 rupees for your investment of 100, another 20 rupees gain for you. For the company, it's a cost. Clear? And sometimes, today, you pay me 100 rupees, but 10 years later, I will pay you back only 90 rupees. It is loss for the investors and gain to the company. No. In case of gain to the company, you never bother about that gain. So you never bother about this. These are the three scenarios you have to understand. Leaving which scenarios out, the redeemable price at discount is not going to be our issue here, because while redeeming I am going to pay lesser means the gain for the company. Any gain for the company can be recognized only on a realization at the end of the life, not now. So forget about this one. So what are the scenarios we have? We have these are the scenarios. Issue at par and redeem at discount. Issue at par, redeem at par. Issue at par and redeem at premium. Two combinations. And issue at premium, redeem at premium. Issue at premium, redeem at par. Issue at discount, redeem at par, and issue at discount, redeem at premium. These are the scenarios. Now see, you can pass the entry for this easily. You can pass the entry for this easily, isn't it? What happens to pass the entry for issuing the debenture at par, premium, discount? You can pass that entry easily. But if supposed to redeem at a premium, okay, you are going to face a loss of paying 20 rupees additionally on maturity period. For that, you have to make a provision. For this only, you have to make the provision. Is that okay? For this, you have to make a provision. What provision? You are going to face a loss on the nth period. So, you create a provisions today. You create a provision. What for what? Premium on redemption. Premium on redemption. That's a loss. Premium payable on redemption. Okay, premium payable on redemption. Okay, this is the loss. But this loss is going to be faced on the maturity period. Okay, so as it is not being the current loss, it can be credited and you can keep a provision here. Provision is here being loss on issue. This is called loss on issue. So the loss on issue being the additional payment you do on the nth period, it is loss on issue. But it is not the current loss. In case of loss, what you can do? In case of expenses, expenses to bank. Or loss means also the same. Okay, expenses or loss you can debit to cash. But you are not going to pay today. You are going to pay when? On the maturity date, probably 5 years later or 10 years later. So until that period, it appears in the premium on discount account. Is that okay? These are the varieties you may be asked to pass the entry like in your examination predominantly for the debentures. For the debentures. Let's see. Let's see. What are the scenarios we have? What are the scenarios we have? Come on. Issue at you issue at par. Issue at premium. Issue at discount. There is no any confusion here. Issue at discount. Apart from that, you state redeem at what? While issuing itself, you state that how I am going to redeem. Redeem at par. Redeem at par. Redeem at par. Redeem at par. This is the first scenario. Okay, means issue of these things with the redeem at par scenario. This one is over. Okay, which scenario is over? This scenario is over. Clear? Issue at par, redeem at par, issue at premium, redeem at par, issue at discount, redeem at par scenario is over. Now let's move on to the next scenario. So issue at par, redeem at premium. Let me finish up the first one. Issue at premium, and next one is issue at par. Issue at discount. Issue at discount. Now what will I tell you? Redemption will be at premium. Redeem at premium. Okay. Redeem at premium scenario. Clear? So this is all about this scenario. This combination. So you have seen two combinations. In the first scenario, the combination being 120, 100, 90, but redeem at 90. This is the first combination. The second combination, the here, okay, 120, 100, 90, but redemption is at premium. Clear? If you are supposed to pay more than its face value on the nth period, it's a loss. How much will be your loss? 20 rupees per debenture. In case if you expect the loss you face on the maturity date, you have to create a provision for that today itself to meet that loss, right? The entry being loss on issue, debit, and premium on discount, credit. This will be for what? For this 20. For this 20. Is that clear? Come on, pass the entry here. Issue at par. What is journal entry? Tell me. Write and tell me. Yeah, come on, come on. For issue at par, the journal entry being single entry, bank account debit to debenture account. That's all. Issue at par means 100 rupees, redeem at par 100 rupees. While redeeming, are you paying extra money? No. So there is no any loss. Entry is over. Entry is over. So issue at par and redeem at par. Simply you can pass the entry like bank account to debentures. If simply you can pass the entry like bank account to debentures. If you are issuing at premium and redeemable at par, what is the entry? Bank account debit to debentures account. Okay, to securities premium. You collect 120, but you credit the debenture with 100 only. 20 rupees is for securities premium. But if you are issuing at discount and redeemable at par, what is the entry here? Bank account debit. So discount being the loss, so I am debiting this. Discount on issue of debenture. Debit to debenture account. The amount credited to the debenture account being 100, collected being 90, the difference between these two is your loss named as discount on debenture here. Now the next scenario being issue at par, but while redeeming, we redeem at premium. Here issue at premium, redeem at premium. Here issue at discount, but redeem at premium. If you are redeeming at premium, then you have to pass an additional entry for the loss you are supposed to face on redemption. On redemption. Come on, what is journal entry for the issue first of all? So bank account debit to debentures account. Debentures account. The value being 100 and 120. 100 rupees, sorry. But redeemable at premium means you have to pay another 20 rupees additionally on redemption, means excess payment. It's a loss. Now, what is journal entry for that? Loss on issue of debit to premium on redemption. Premium on redemption. Is that clear? You can either pass that entry separately or you can incorporate as a single entry here. I am debiting the loss on issue of debenture account debit to premium payable on redemption, value being 20. Clear? So, with that existing journal entry, you add this additional entry. When? If you are supposed to redeem at premium. The entry for this, issue at premium, bank account debit, premium, no. So, securities premium account debit, sorry, to securities premium and to debenture. 120 rupees you collected for the debenture value rupees 100, 20 rupees being the securities premium. Clear? This is for issue of your debentures at premium. But you are supposed to redeem at premium, right? So it means you are going to face a loss on redemption. Then add this journal entry with this. You have to debit what? Loss on issue of debenture, debit. But this loss you will be paying not now, later on. So it is not transferable to the P&L account. It will be kept as a reserve account. That name will be premium on redemption. Premium on redemption. This value being 20. Next one will be issue at a discount. What is the entry for issue at discount? Bank account debit, discount on issue of debenture to debenture. This is for issue first of all. The value being 90 is the collection, 10 rupees being the loss, 100 rupees being the debenture. As you pay 20 rupees higher on redemption, you have to add this entry also with the existing entry. So the entry being loss on issue account debit to premium on redemption. This value being 20. Hope now you'll be able to understand this one. Clear? Now, I'll just explain you one more logic called how can we adjust the losses. The loss scenario, this scenario. Now see here. This is nothing but issue of debenture at discount redeem at premium. Because of this scenario, what could be your loss? Discount on issue is a loss. Supposed to pay additional amount at the time of redemption, also one more loss. So these are the two losses we face. These are the two losses we face. Am I right? Clear? Any of that loss should be debited to the P&L account only, no? Now this 20 and 10, 30 rupees we have the loss. Loss on issue as well as discount on issue. The loss will be debited to the P&L account. How do we debit? The debit will be as per the redemption terms. See, redeem at the end of 5th year. At the end of 5th year. At the end of 5th year. Redeem at the end of 5th year. So if supposed to redeem at the end of 5th year, this 20 and 10, how can you handle? 30 rupees loss. 30 rupees is a loss. How can you handle? Every year you can debit to the P&L account 1/5. Just similar to depreciation. Straight line method of depreciation like. So what is your loss? 30 rupees is your loss. Can be amortized over the life of the asset or life of the debenture. So 6 rupees. Every year you can debit 6 rupees in your P&L account. Come on, tell me the journal entry for this. For the first year end. Okay. You debit to the P&L account 6 rupees. What can we debit? You can debit as your choice. 20 plus 10, 30 rupees you have. You can debit 20 plus 30, 6 rupees can be debited. Maybe this will be discount on issue as well as loss on issue. How much? 6 rupees. Thereafter the balance 20 plus 30 decreases to 24. Second year end, P&L account debit to what? Discount on issue. Discount on issue we have how much? Out of 10 already we have written down 6 rupees. Still we have 4 rupees. But how much we have to debit to P&L account? 6 rupees. Another 2 rupees can be debited from loss on issue. To loss on issue. Loss on issue. Second year. Third year, P&L account debit to loss on issue 6 rupees. Fourth year, P&L account debit to loss on issue. Fifth year, P&L account debit to loss on issue. You repeat that. Ultimately, the entire 30 rupees should be amortized over 5 years period. The life of the debenture. Clear? Now, what happens here? Redeem in 5 equal installment. The debenture 100 rupees you know, the face value of the debenture 100 rupees you know, redeemed 5 years period, over 5 years period. Okay. How can you handle this scenario? Now, assume that the face value of the debenture being 100 at 0th period. First year you redeem how much? 20 rupees. Because you are redeeming that in 5 installments. You don't redeem or pay back this 100 rupees at a stretch. You pay back over 5 years period. Year on year you are paying 20 rupees back. Then what about the balance after the redemption every year end? Okay, first year you have 100 rupees. Second year beginning, after 20 rupees redemption, you have how much in your debenture balance? 80. Third year, again you redeemed 20 rupees. Hereafter, how much loan should be repayable? Loan means debenture should be repayable, 60. Then fourth year, 40. Fifth year beginning, you have 20 rupees. In the last date, you paid completely. So first scenario is redeeming the complete thing put together in single shot at the last day of the redemption date. In the second scenario, because it's really tough to arrange all the 100 rupees, rather than year on year 20 rupees arranging and settling will be comfortable. EMI, like equated annual installment, EAI, okay, equated annual installment, like, so year on year they are paying 20 rupees. In this case, how can we amortize, sir? In this case, you can amortize based on this weightage method. What is the total due we have over the 5 years period? 300, summation of this one. So overall loss being 20 plus 10, 30 rupees. This 30 rupees will be amortized in the very first year. How much? 100 out of 300. 100 out of 300. Overall due being 300 rupees. In that 300 rupees, 100 rupees exists in the very beginning of the year. So 100 by 300 will be the amortized value in the very first year. Second year, okay, 80 into 30 into, what is the balance due you have by the in the beginning of second year? 80. So 80 by 300, then 30 rupees is the amount amortized over the period into 60 by 300, and then here 30 into 40 by 300, and here 30 is the loss into the loan in the beginning divided by overall summation of all the loan put together in all the years. Then this value being 10 rupees very first year, 8, 6, 4, 2. That's how the loss may be amortized. This 30 rupees will be amortized over the periods. In the very first year, you amortized 10 rupees, 10 rupees. Next year, 8 rupees, 8 rupees, 8 rupees, 8 rupees. That's how you can amortize. Whatever the loss you face because of issuing the debenture will be amortized anyhow by debiting to the P&L account. Like any asset you have, you know that asset's value reduction is debited to the P&L account in the form of depreciation. Usually we have the SLM method as well as WDV method. Similarly, here also we have the SLM method. When all the loan put together redeemed in the nth period, then it will be amortized over the 5 years period. Rather than that, if you are repaying the loan in installments periodically, then find out the loan amount exists in the day one of the year for all the year until the full loan is settled. Based on the year beginning loan divided by summation of all the loans available in the year beginning, to that ratio of any loss you have can be amortized in the very first year. So go on year the same way. Illustration yourself. Question number 4. This is how the questions may be expected in your examination. Examination question. Past journal entries in case of issue of debenture by ABC company issued 1 lakh rupees 11% debentures at 95%, redeemable at the end of 10 years at 102%. Okay. So issue at what? 95%, 5% discount. Redeem at what? While redeeming, you redeem at 102%. What does it mean? This is discount, this is premium. Scenario 1. Value of the debenture being 1 lakh. Come on, pass the entry for this. Scenario 2. Issue at 95%. Discount. Come on, get me the value. What's the journal entry here? I request the foundation students get me the answer. Make it faster. Tell me the answer. Come on. So the entry here being, you collected only 95,000 rupees. 95% of the face value is collected. On repayment, 1 or 2% of 1 lakh is repaid. Means issue at discount by 5,000 rupees, repayable at premium by 2,000 rupees. So bank account, the amount collected being 95,000 to 11% debenture, the face value of the debenture in this case being 1 lakh. So the difference between these two, discount on issue of debenture, discount on issue 5,000 rupees. On repayment, you paid 2,000 rupees additionally. As you are paying extra money, it is loss or loss on issue, debit. And 2, this is not being the current loss, may be payable on redemption. So premium on redemption, the value being 2,000. Clear? For the second question, issue at 95%, for 1 lakh being the face value, issue price being 95% on this, which is 95,000. Redeemable at 98%, 98,000 rupees. Redemption at discount, issue also at discount. First you pass the entry for the issue case. What is the journal entry for the issue? So bank account debit, discount on issue account debit to 11% debentures account. The value being 95,000, 5,000, 1 lakh. What about this scenario? What about this scenario? Archu and Naranjana Devi gave me the answers but not correct. In case of redeeming at lesser value, is it profit for you or not? Profit only. If you are repaying lesser than the loan borrowed, it's a profit. In case of profit happening the later period, you should not record that in your books. Okay. So we have to forget discount on redemption. Discount on redemption we have to omit. As per the conservatism concept, this difference between these two, the 98 and 2,000 rupees you gain, no. That gain will not be worried about or will not be considered for the accounting. You can record only on realization. At the time of redemption only we will record. We never provide any reserve for this purpose. Clear? It is not loss, actually it's a gain. Okay. Because the debenture in our book appearing at 1 lakh, repaying at 98,000 rupees. Definitely you are repaying lesser value, it's a gain for you. Gain will not be recorded at all. Come on, try the next sum. Question number 5. 5, I may explain myself. 5th sum. 6th you can try it yourself. 6th you can try it yourself. You have studied in issue of shares. What's that? Issue of shares in consideration other than cash. Sometimes you purchase the asset. For the purchase of assets, consideration may be in the form of equity shares. Isn't it? Similarly here, question number 6. We purchased property, plant, equipment for rupees 10 lakhs. For rupees 10 lakhs. Okay. But the payment is made by way of debentures. So issue of debentures for purchasing the asset. So the journal entry being, okay, assets account debit to debentures account. That's all. You can try it yourself. Question number 5. Mahi Limited taken a loan of rupees 15 lakhs from the SBI, issuing 25,000 12% debentures of 100 each as collateral security. Pass necessary journal entries in the books of the company. Now, for the loan, what is journal entry? Bank account debit to loan account, bank loan account, the value being 15 lakhs. When you are issuing the debentures as a collateral security, see, if you want to purchase borrow any loan from the banker will demand some security to be given. Give me the jewel loan. If you want to purchase the home loan, pledge your home, you cannot sell thereafter. So the house property is pledged with the banker. Home loan. For vehicle loan, you pledge the vehicle, mortgage your vehicle and pledge. So in case of jewel, we use the term pledge. In case of house property, we use the term mortgage. In case of vehicles, we use the hypothecation. You have to understand the terms difference. Okay. In case of jewelry, it's a pledging. In case of house property loan, it is called mortgage. In case of vehicle loan, it is called hypothecation. But I borrow the loan without any securities. Banker will be having doubt whether will you pay or not. So they ask you to give debenture in additional security, that is called collateral security. You don't get any cash for the collateral security. In that case, the journal entry in this case being debenture suspense account debit to 11% debentures. 25,000 into 100, 2.5 lakhs. 2.5 lakhs. It's a dummy entry. We don't get any cash. See, this will be appearing in your balance sheet as bank account and bank loan. Okay. And debenture suspense to 12% debentures. Is that okay? How much is that? 25,000, 25 lakhs, right? Sir, this is 25 lakhs. Okay, 12% debentures. This is a journal entry to issue the debentures as a collateral security. What happens on repayment? You have to repay this loan only. You are going to repay this loan only. Loan account debit to bank. You repay. What about this one, sir? It's only a dummy entry, no? You are just reversing the dummy entry. You don't get any cash inflow or outflow regarding this. So 12% debentures account debit to debenture suspense account. This is called cancellation of collateral security. So 10 lakhs is the asset value. You issue the debenture for rupees 100. So 10 lakhs divided by 100. How many debenture you have to issue? 10,000 debentures at rupees 100. This is the scenario 1. Scenario B, 10 lakhs, but your debenture worth rupees 125. 100 rupees debenture issued for 125 means premium. How many debenture you have to issue? 8,000 debenture. Am I right? Yes or no? So into 100 is the face value, into 25 will be the securities premium. And in case of 80, 10 lakhs divided by 80, come on, tell me. 12,500 debenture you have to issue, where 20 rupees being the discount to be deductible. The entry for purchasing the plant and machinery being property, plant, equipment to what? Vendor. Like you can post the entry payable to them, or creditors for the property, plant, equipment. Now settle that. Vendor to property, plant, equipment account debit to you issue 10% debentures, value being 10 lakhs. Second scenario, vendor, the amount payable to the vendor being 10 lakhs, but 10% debenture issued being only 8,000 into 10, 100, 8 lakhs, but you get what? securities premium 25 each into 8,000, 2 lakhs. The last scenario, the amount payable to vendor being 10 lakhs and the payment by way of debenture, 10% debenture being 12,500 into 100, 12.5 lakhs, and actually you are losing 2.5 lakhs as named as discount on issue of debenture. Clear? Last sum, seventh one, a comprehensive illustration. We start issue and finally we go for redeeming. Seventh question is a comprehensive illustration. Seventh one is a comprehensive illustration. Okay. Now, seventh question. A company issued 12% debentures of face value rupees 10 lakhs at 10% discount on 1/4/2017. Right. All the debentures were redeemed after the expiry of 3 years, 5% premium. Issue at what? Discount. Redeem at premium. 10 lakhs, 5% discount and 10% premium. This is on issue. This is on 10%. Okay. 10% discount and premium 5%. Okay. And debenture interest after deducting TDS, tax deducted at source 10% was payable on 30th September and 31st March every year. This is 12% debenture. Interest is payable twice in a year. Interest will be payable twice in a year. When? 30th September, 31st March. Year starts on 1st April 2017, redeemed on 3 years later, 31st March 2018, 19, 20, so 2020, redemption date being this one. It's one of the comprehensive illustration. It is one of the comprehensive illustration. Here we have the TDS also. TDS being 10%. Subject to TDS 10%. Now, let me solve this illustration. Come on, join with me. What is the first journal entry on 1/4/2017? 1/4/2017. You have to pass the entry for this. Come on, tell me the entry. Bank account debit. Bank account debit. So you issue at discount. So discount on issue, debit. And you supposed to pay more. So it's a loss on issue. Debit to 12% debentures account to premium on redemption. The face value of the debenture being 10 lakhs. And 10% discount being 1 lakh. The premium payable on redemption, which is the loss, 5% on this being 50,000. Amount collected being after the discount 10 lakhs minus 1 lakh, you collected 9 lakhs. Premium 50,000 will be payable on redemption being 50,000 rupees. Hope now you will be able to understand this entry. So for the 3 years, you are paying only interest. By the end of third year, you are going to settle the debt completely. Come on, pass journal entry for the payment of interest. What is the due entry for interest payment? For the every year, September and March, twice interest is payable, half yearly once. For the year 2017 and 18, first half year being 30/9/2017, first half year. Interest account debit. How much interest is payable? The value being 10 lakhs, so you know. For that rate of interest being 12%. For how many period you have to calculate? 6 months. Once in every 6 months, they are paying the interest. So 6/12. 6/12. 60,000 will be your interest. Am I right? 60,000 will be your interest. But while paying this interest, TDS is applicable at the rate of 10%. Means this 10% on this amount is not payable to the recipient, debenture holders. It is going to be deposited in the TDS account. Okay, it's separate account. It is deposited to government. He can recover that while paying the tax. Okay, I have incorporated that in the journal entry preparation itself. Anyhow, just learn here. Interest account debit to TDS account, TDS payable account. 10% on this being 6,000. Immediately the amount payable to the owner being the debenture holders. Debenture holders. 54,000. Due entry is passed. Now you have to pass a payment entry. What's the payment entry? Debenture holders account debit. How much? 54,000. And TDS payable account 6,000, and payment is made being bank, the value being 60,000. Hope you will be now able to understand this. Any doubt? Now, first due date is over. Second on 31st March. 31st March 2018. 2018. Is that okay? Now, 2018 interest account debit due entry to TDS payable to debenture holders. How much is that? Again 60. Every 6 months they will pay interest of rupees 60. While paying 6,000 will be payable to TDS account, 54,000 will be payable in the debenture holders bank account. Due entry is passed. Now I have to pass a payment entry. Debenture holders account debit and TDS payable account. TDS payable account. Debenture holders, their bank account gets credited with 54,000 and his TDS account will be credited with 60,000 rupees to bank. What happens in case of year end? What happens in case of year end? You have to transfer the nominal account to the P&L account, right? P&L account. So I am going to transfer the nominal account to the P&L account. C. What are the nominal accounts we have? P&L account debit. What are the nominal accounts we have? Interest. These two are the nominal accounts. Apart from that, in case of loss and discount, amortized over the life. How many years we have to wait for redeeming that? 3 years. So this will be amortized over 3 years period. Okay, this will be under straight line method. Like interest will also be debited to the P&L account. In case of discount and loss, those things are debited over 3 years period. Then entry being P&L account debit to interest. How much? 60 plus 60, 1,20,000. Not only that, to discount on issue and loss on issue. 1 lakh plus 50, 1 lakh 50, but how much I am going to write off? Only 50. So the amount debited to the P&L account being 1,70,000 rupees. Is that clear? Are you able to understand? Clear? So every year, half yearly once you have to pay the interest. Year end, all the interest, the nominal value, nominal accounts are going to be transferable to the P&L account, means closing the ledger accounts. Closing the ledger account. Then what happens the next year? 39/2018. Again you pass the entry. 31/3/2019 you pass this entry. Second year the same entry will be repeated. I am not going to pass those entries. It's going to be repetition only. And then the last year 39/2019, 39/2019 and 2020. 3 years over. 3 years over. So first year what entry you pass? For the first 6 months interest, for the second 6 month interest, when it is being the last day of the year, all the nominal accounts and the amortizable loss and discount on issue will be also transferred to the P&L. So 33/2020. You are going to redeem. Debentures are going to be redeemable. So debentures account debit. While redeeming, what we do? We pay 5% additionally. The debenture value being 10 lakhs. But we pay 50,000 rupees excess. That will be called as premium on redemption. To debenture holders. Debenture holders value being 10 lakhs 50,000 rupees. 10 lakhs 50,000 rupees. Is that clear? Make the payment to the debenture holders. Debenture holders account debit 10 lakhs 50,000 rupees. Make the payment to bank, or you can club these two as a single entry. Debenture account debit, premium on redemption of debenture account debit to bank. That's how you can club these two entry to make it single entry. Remember that the premium on redemption we have created while issuing is now used. Used means debited. So until that period, the debenture, the premium on redemption appearing in the balance sheet as a reserve. The moment you are redeeming, you are using it. Debited, that's all. Clear? You created the PDD. While you face a bad debt, the bad debt is adjusted in the PDD is closed. Clear? The same logic happens here. Premium on redemption is created on issue, and that premium on redemption is used on redemption. So that becomes zero. Clear? So we'll deal with the redemption of preference shares. You issue the preference share. Further, normal journal entry is passed like equity share capital. Rather than equity share capital, you name it being preference share capital. Bank account debit to preference share application to preference share capital. That's all. But redemption case, listen here. Redeemable preference share capital. Probably we have say 10,000 rupees. While redeeming, you may redeem at par, or you may sometimes pay more than its worth. That excess payment is called premium on redemption. Around 1,000 rupees you are paying excess. Is that clear? Redeemable preference share capital being 10,000, premium on redemption being 1,000. How can you redeem this? You can redeem this out of proceeds from fresh issues. Proceeds from fresh issues. Or you can use a free resource. You can use a free resource. After the redemption, you have to cross verify proceeds and CRR should match with the face value of redeemable preference share capital. Okay. Proceeds plus CRR should match with the face value of redeemable preference share capital. Always cross verify this. If you are using the free resource for redemption purpose, free resource will be named as capital redemption reserve after redemption. Now you have to understand what is called proceeds. Face value 100, issue price being 100. Then what about the proceeds from every share? Proceeds from every share being 100. If the 100 rupee share issued for 120 with the premium, then proceeds from issue being 100 only. Hope you will be now able to understand. From this, it is very clear, profit excludes the securities premium. Profits excludes the securities premium, only the face value. CRR is otherwise named as Capital Redemption Reserve, a special reserve created by transferring the free reserves to CRR on redemption. And point number 2 to be noted here is cash verification. Cash verification. Cash needed for redemption of preference share. Okay. Redeemable preference share capital and premium on payment. Premium on redemption of preference share capital. Redemption of preference share capital. The amount required. What the amount available here? Maybe issue of shares. Issue of shares. Maybe including the premium also. I am talking about the cash requirement calculation. Cash requirement calculation. This is what about the condition. Legal condition. What is the legal condition? Proceeds plus CRR should be equal to the face value of the redeemable preference share capital. And for the cash requirement for repaying that, how much you have to pay? 10,000 plus 1,000, 11,000 you have to pay. For that, how much you get the money by issuing the shares? By issuing the shares, face value plus securities premium, you will be getting the money. Do you have any balance already available? Balance already available. Balance available in cash or bank, whatever it may be. Subtract these two. This is the sum amount required for you. Amount required for you. Any shortage of cash can be available or made available by borrowing or by selling the asset. By selling the asset or investment. Okay. Clear? So by selling the asset or loan. Two aspects to be covered here. Two aspects to be covered here. Clear? You have to understand these two aspects here. One is the legal requirement verification, another one is cash requirement satisfied or not. How can you pass the entry to solve this? For issue, the journal entry being very simple. Bank account debit to equity share capital or preference. Issue means it represents only equity share capital and preference share capital. Okay. And of course, including securities premium. This is the entry for the issue. How can you redeem, sir? For redemption purpose, first you have to pass a due entry. What is the due entry? Redeemable preference share capital account is usually credit balance. Now, to redeem that, it should be cancelled by debiting. If you are paying more worth than premium on redemption account debit, to redeemable preference shareholders. Redeemable preference shareholders. This is the next entry. Due entry to pay. Second entry is the payment entry to the redeemable preference shareholders. Redeemable preference shareholders account debit. Bank. Now we are settling this. And if you are paying more value than the face value, it's a loss only, no? Can be adjusted in the free resource. Okay, sometimes it can be adjusted in the securities premium account also, but for the CA, you give the priority to the free resource only in CA. Because the company falls under section 133, they are not allowed to adjust this in the premium, securities premium account. So you can adjust that in the free resource account. This excess payment premium on redemption can be adjusted in any free resource. Further, the journal entry being free resource account debit to premium on redemption. And while calculating if there is any shortage, profits plus CRR should be equal to the face value of redeemable preference share capital. If there is any shortage, find out the balance. That balance will be transferable from free resource to CRR. Free resource to CRR account. Clear? These are the 4 entries. For the fund requirement, 5th entry. If needed, you can either borrow. If you borrow, the journal entry being bank account debit to loan account. Or if you sell the asset or any investment, the entry being bank account debit to asset account. Asset or investment account, or even in the case loan or debenture. While selling the asset, you will either get profit and loss, right? So in case profit on sale, that will be credited. In case of loss, debited to profit and loss account. So loss on sale. So these are the 5 entries you have to be mastered to complete redemption of preference shares comfortably, right? Now you have to understand what are called free resource. Divisible profits are called as usually free resource. Or reserves available for distribution of profit, dividend will be called as divisible profit. General reserve, reserve fund, dividend equalization fund, insurance fund, workman compensation fund, workman accident fund created voluntarily, voluntary debenture redemption fund, voluntary debenture sinking fund, and profit and loss. All these things are example for the divisible profits. Securities premium, forfeited shares, capital reserve created after selling the shares from forfeiture of shares will not be divisible profit. Profit prior to incorporation, capital redemption reserve that we create now, capital redemption reserve, as well as capital reserve from revaluation of assets, unclaimed dividend if any, development rebate reserve. These are called non-divisible profits. See the theory. Redeemable preference shares. A company limited by share may issue redeemable preference shares if article of association authorized. And the redeemable preference shares tenure should be less than or equal to 20 years only. It should be redeemable within 20 years. Redeem only fully paid up preference share capital. Partly paid up preference share capital cannot be redeemed. Redemption can be out of profits or free resource. Profits means the issue price less securities premium. It should not include the securities premium from fresh issue. Fresh issue means maybe equity shares or preference shares, but does not include debenture here. Does not include. The issue of fresh issue means only equity share capital, preference share capital, debenture will not be includable. Free resource, transfer up to nominal value of shares redeemed to capital redemption reserve, CRR. Okay. Transfer of free resource to capital redemption reserve is required. Already told you, from the free resource you have to transfer. Okay. Now, cash required for redemption purpose, funded by what? Cash available for payment and sale of investment, balance you can create using the debenture loan. This is what about the cash requirement. And for the redemption of preference share, Face value of the redeemable preferred share capital should be equal to what? Proceeds and CRR transfer. This is legal requirement. This one being the legal requirement, this is all about cash requirements. You have to understand these two cases, right? So this is separate and this is separate. You have to cross verify whether these two are matching always or not, right? So with this logic, we'll try to solve this illustration, okay? Now, we'll start with the question number 1 here. $10,000 redeemable preference shares available in the balance sheet is decided to redeem out of fresh issue. Redeemable preference share capital value being 10,000. Calculate the minimum number of shares to be issued to redeem the preference shares and pass the journal entries in each of the following situations. The share issued at rupees 10. We'll see the situation number 1, not the second one. What is the profit per share? If the share issued at par, the face value will be the profits. 10 rupees is the profits. What is the profits required here? Profits required 10,000 rupees. You need 10,000 rupees by issuing the profits. For every share you will be getting 10 rupees profits, means 1000 shares are to be issued. Are you having any premium on redemption in this case? No premium on redemption. No premium on redemption. Can be redeemed out of proceeds from fresh issues or transferring the free resource to CRR. Okay, if there is any excess payment, it's a loss transferable to or adjustable to free resource account. Now, what is the profit requirement? The profits requirement being 10,000 rupees. By issuing every share, what is your profits you are getting? Only the par value means 10 rupees you are getting. So 1000 divided by 10, 10,000 divided by 10, 1000 shares to be issued. By issuing 1000 shares, you will be getting 10,000 rupees profits. 1000 into 10, you will be getting 10,000 rupees. What is the legal requirement? Legal requirement being face value of redeemable preference share capital being 10,000 should be equivalent to what? Should be equivalent to proceeds from fresh issues. Okay, CRR creation being 0, not required. Not required. Always cross verify the proceeds from fresh issues should be, or proceeds from fresh issues and CRR should be equal to face value of the redeemable preference share capital. That's a main condition you have to understand. Clear? See this one. Face value of the redeemable preference share capital should be equal to proceeds and CRR transfer. Here proceeds being 10,000 rupees and face value being 10,000 and CRR transfer becomes 0. 0. Is that okay? Next one is cash requirement. What is the cash requirement here? Cash requirement for paying the debenture being 10,000 rupees. So redeemable preference share capital payment being 10,000 rupees. By proceeds, how much you will be getting? 10,000 rupees. So you don't have any shortage of money. You don't have any shortage of money. Now you can pass entry. Entry for issue and due entry for payment to the redeemable preference share capital, and next one being payment for that. Okay, payment. These 3 entry we don't have loss on redemption. So this entry is missing. We no need to create the CRR, so this entry is also missing. Only 3 entries to be passed. First entry being, come on, tell me. So the journal entry for issuing this bank account debit to equity share capital account, the value being 10,000. Second one being the due entry. For the due entry, redeemable preference share capital account debit. Okay, we don't have the premium, so redeemable preference shareholders account, the due entry being 10,000. Third entry being payment entry. Redeemable preference shareholders account debit to bank. To bank, the value being 10,000. Hope you'll be now able to understand this one. Clear? Clear? We don't pass any entry for adjusting the loss because there is no loss. We no need to create CRR because CRR not required. Now, Here I am going to solve the second part of this illustration. Always remember, for redemption of preference share, you frame the format. What is that? Redeemable preference share capital, face value. If you are paying excess than that, that is called premium on redemption. Total value. You can redeem out of proceeds and transferring the free resource to CRR. And if there is any excess payment, that is loss, will be transferable to or adjustable to free resource. Entry 1 is for issuing the share, entry 2 is for the due, entry 3 is payment, entry 4 is to adjust the loss, entry 5 is transferring the free resource to CRR, entry 6 if needed, borrow or sell your assets. And 2 working note. One is all about legal requirement. What is a legal requirement? Face value of redeemable preference share capital should be equivalent to proceeds and fresh issues. Should be equal to proceeds and CRR created. Then fund requirement, payment to redeemable preference shareholders, where fund arranged by issuing equity share capital, face value plus securities premium or issue price, and balance of cash already you have. So these are the two funds we are in available already. Shortage will be arranged by way of loan or sale of investment or asset. This is the amount required, this is the amount made available. If you understand this picture, the topic is over. You have to repay the redeemable preference shareholders funds. How can you repay? By collecting fresh, by issuing the fresh share, we can collect the money, or you have to transfer the free resource to CRR. Legal requirement being the face value of the redeemable preference share capital should be equivalent to the proceeds in CRR, and cross verify whether the fund is also available. These are the set you have to make it available. Now let's see. I am going to feed the data. 10,000 redeemable preference share capital available in the balance sheet is decided to redeem out of fresh issue. So completely fresh issues. Okay. Calculate the minimum number of shares to be issued to redeem the preference shares and pass journal entries in each of the following situations. Means issue at a premium 12 rupees. Face value 10. Issue price is 12 including premium. Then what is the proceeds here per share? Proceeds being 10 only excluding securities premium. We should not include the premium. So proceeds per share being 10. How many shares we have to issue to make the proceeds available to redeem this? I am in need of 10,000 rupees to redeem this. For every share, I can get 10 rupees proceeds. So 1000 shares to be issued. 1000 shares to be issued. Is that okay? Now, what is the proceeds we'll get? We get proceeds of rupees 10,000. What about the face value of the preference shares supposed to be redeemed? 10,000 rupees. What about the CRR requirement? Nothing, because not some equally matching. The face value of the redeemable preference share capital is 10,000 rupees. We collected the proceeds also 10,000 rupees. We don't worry about the CRR creation here. As we no need to create the CRR, this entry is missing. There is no loss on reissue, loss on redemption. So this entry is also not required. Only 3 entries are going to be passed. And here you can cross verify how much you have to pay, 10,000 rupees, how much you are getting. By issuing 10,000 shares, for every share you are getting 12 rupees, means you are getting 12,000 rupees more than amount available. So there is no shortage. We no need to borrow or we no need to sell the assets. Only 3 journal entries are going to be passed. Come on, pass the first entry. So issue of shares at rupees 12. Bank account debit. How many shares are issued? 10,000 shares are issued at rupees 12 each. 12 each. Okay. Bank account debit to equity share capital to securities premium. You collect 12,000 rupees but credited to the equity share capital being 10,000 rupees, 2,000 rupees into 1,000, 2,000 rupees is the securities premium. Now for the due entry, the amount payable to the redeemable preference shareholders being 10,000, pass a due entry here. Redeemable preference share capital account debit to redeemable preference shareholders account, the value being 10,000 rupees. Now you make the payment to them. Redeemable preference shareholders account debit to bank. To bank, how much? 10,000 rupees. We don't pass rest of the other entries. Only 3 entries. Only 3 entries. Clear? We will go for the question number 2 here. Come on, solve this illustration. You draft the picture first. Join with me to draft the picture. What is the picture? Redeemable preference share capital premium on redemption. That's a total amount. One is out of proceeds, another one being conversion of free resource to CRR. And cross verify face value of redeemable preference share capital should be equivalent to proceeds collected plus CRR transferred. And for the fund, this is what about the legal requirement. And next one being cash, arranging the cash. What about the amount required for paying the redeemable preference shareholders? Now minus amount collected by issuing equity share capital, issue of share capital, and bank balance if you have anything, bank or cash balance. After that, if there is any shortage, that shortage can be arranged by borrowing or issuing the debenture or sale of assets or investment. Sale of assets or investment. That's a structure. You have to pass the entry for issue the shares, due entry, and payment entry. If you are paying excess, this is a loss. This is a loss. Can be adjusted in the free resource. 4th entry. And creation of CRR, 5th entry. And for this 6th entry. Okay, arranging the loan or sale, only these 6 entries. We don't expect all the 6 entries will come. Only few entries will come. You can pass those entries alone. I am feeding the data here. 10,000 redeemable preference shares available in the balance sheet, decided to redeem out of free resource. So from this it is very clear, they redeem out of free resource only, not out of proceeds. Calculate the amount to be transferred from capital redemption reserve on the date of redemption. The face value of the redeemable preference share capital being 10,000, proceeds being 0. Then what about the amount we required to create CRR? 10,000 rupees. Earlier we use the proceeds, now we don't use the proceeds, we need to create the CRR. CRR can be created by transferring the free resource to CRR. Okay. On the redemption date, the following balances are available in the books. General reserve, free reserve. Dividend equalization reserve, also free resource. Capital reserve is not free resource. Securities premium is not free resource. And profit or loss being the free resource. We have 3 free resource. Already told what are called free resource. In the very first page itself, I guided you. These are called free resource, right? General reserve, free reserve, reserve fund, dividend equalization fund, insurance premium, profit and loss. All these things are the example of the free resource. Securities premium, forfeiture of shares, profit prior to incorporation, capital reserve from forfeiture of shares, capital reserve on revaluation of assets, unclaimed dividend and development rebate reserves. All these things are not considered as divisible profits. Okay. So from that you can easily understand only the 3 are called as free resource. What are they? General reserve, dividend equalization reserve, profit and loss. How much I need? 10,000 rupees. 10,000 rupees I can take the GR fully, and dividend equalization reserve 3,000 fully. 6,000 are now we have taken. Still we need another 4,000 rupees. From here we can take another 4,000 rupees. So the profit and loss will have a balance of rupees 1,000 after this also. Now pass the entry. We don't have entry for the first one. Due entry being redeemable preference share capital account debit to amount payable to the redeemable preference shareholders, value being 10,000, and make the payment to them. Redeemable preference shareholders account debit to bank, the value being 10,000. No entry here, and in this case 3 free resources are going to be used. I need 10,000 rupees. How much I need for the CRR? 10,000 rupees I am in need. I calculated already. How can I arrange this? From the GR 3,000, from the profit and loss, from the dividend equalization reserve 3,000 rupees, still I need 4,000 rupees is taken from the profit and loss account. So profit and loss account debit 4,000 rupees. Fund arrangement, we assume we need to pay 10,000 rupees. Already we have 10,000 rupees in our balance. We need not to raise any loan or sell the assets. Unless it is stated, you no need to worry about this cash calculation. Unless loan is raised or asset is sold for shortage of fund, you no need to worry about this one. Is that okay? It is assumed that we will move on to the next illustration. Question number 3. Redemption of preference share. Now, preference shares. It's a comprehensive illustration. You have to pass the entry and then prepare the ledger, balance sheet. Preference shares are to be redeemed at 10% premium. So in the balance sheet, share capital schedule number 1. In schedule number 1, we have 2 shares, equity shares and preference shares. These preference shares are going to be redeemed. Form the format here. Okay. Redeemable preference share capital. Premium payable on redemption. So redeemable preference share capital being 5 lakhs. Premium payable on that being 10%, 50,000 rupees. Fresh issue of equity share is to be made to the extent it is required under the Companies Act. What the Companies Act says, legal requirement, face value of redeemable preference share capital should be equivalent to proceeds plus CRR creation. Now, fresh issue required only to the extent required as per the Companies Act. Shortfall in funds for the purpose of the redemption after utilizing the proceeds of the fresh issue is to be made by bank loan. Here shortfall is from bank loan. What's the second one? For the fund requirement, for fund arrangement. Payment to redeemable preference share capital for the redemption purpose. Redeemable preference shareholders payment. How much we have to pay? 5,50,000 rupees will be payable. How can we arrange? By issuing the equity share capital. The shortfall in funds for the purpose of redemption after utilizing the proceeds of the fresh issues. What are the equity share capital issue? No, amount you collected can be used for repaying the debenture of preference shareholders fund. Balance, if any, can be arranged by raising the loan. So here we have the legal requirement to satisfy for the CRR creation, as well as we can find out the fund requirement also for raising the loan. Now can be redeemed out of proceeds. And what? Transferring the free resource to CRR. As there is a loss, this loss should be adjusted in the free resource. Entry number 1, issue. Entry number 2, due. Entry number 3, payment. Entry number 4, this loss adjustment. Entry number 5, CRR creation. Entry number 6, borrowing the loan. 6 entries to be passed. Now, here the statement is very, very important. Fresh issue of equity share is to be made to the extent required. Means predominantly you depend on free resource conversion. What are the free resources we have? Capital resource is not free resource. Securities premium is not free resource. General reserve and profit and loss, these two are the free resource. These two are the free resource. Right. Out of the 2 lakhs plus 1 lakh, 3 lakhs we have, you have to use 50,000 rupees for what purpose? To write off the premium on redemption. As we use almost 50,000 rupees to write off the premium on redemptions, we left with only 2.5 lakhs. So that 2.5 lakhs can be transferable from these two free resources to CRR. Come on. What is the face value of the redeemable preference share capital? 5 lakhs. How much we created the CRR from the free resource? 2.5 lakhs. And how much is the shortage? 2.5 lakhs will be the shortage balancing figure. This can be raised using the fresh issue process. Now, this will be process means you have to issue 2.5 lakhs worth equity share capital. 2.5 lakhs worth equity share capital. This is the balancing figure we arrived from the legal requirement. Clear. Now 5 lakhs 50,000 we need to pay, where by issuing the equity share we collected how much? 2.5 lakhs. What is the shortage of fund? 3 lakhs. 3 lakhs can be raised by issuing, from borrowing loan. This is the second calculation. Now pass the entry. For the first one, equity share issued, bank account debit to equity share capital, the value being 2.5 lakhs, 2.5 lakhs. Due entry, redeemable preference share capital account debit, premium on redemption account debit to redeemable preference shareholders account. This is 5 lakhs, this is 0.5 lakhs, this is 5.5 lakhs. Now pay to them, redeemable preference shareholders account debit to bank, the payment being 5.5 lakhs. And for this premium on redemption loss is adjusted in the, I can adjust in the P&L account debit. Okay, for this I can pass the entry here. For the fourth one, P&L account debit to premium on redemption. How much? 0.5 lakhs. This is adjusted. And fifth one being creation of CRR. This 1 lakh already 50,000 used. So we still have 50,000 rupees. We have GR fully, and P&L account we have only 0.5 lakhs. This entire value is transferred to CRR, the value being 2.5 lakhs. And the fund requirement is raised, bank account debit to loan account. We borrowed. How much? 3 lakhs. So we passed all the 6 entries here. This is one of the comprehensive illustration. We passed all the entries here. Now I am going to incorporate all these entries to prepare new balance sheet. Redeemable preference share capital debit and existing being credit gets eliminated, it becomes 0. Premium on redemption debit, premium on redemption credit, it becomes eliminated totally, we don't have any balance. General reserve 2 lakhs we have, but by debiting it becomes 0. And profit and loss we have 1 lakh rupees in credit, we debited 50,000 rupees and we debited another 50, so it becomes 0. Okay, now what about the bank? We have 3 lakhs received by getting the loan, 2.5 lakhs by issuing the equity shares, 5 lakhs 50, but we paid this for the redeemable preference shareholders, so it becomes 0. And redeemable preference share capital credit and debit In net, it's 0. We don't have any balance. And we now increase the equity share capital by 2.5 lakhs. Hereafter, the equity share capital being 12.5 lakhs. And loan being 3 lakhs. Loan being 3 lakhs. May be addable here 3 lakhs. I assume this is being non-current liabilities. I assume this is being non-current liabilities. Loan. The value being 3 lakhs. New one has come. And still we have the CRR. Capital redemption reserve is also a reserve here. So I name this being CRR under reserves and surplus 3 lakhs. So 2.5 lakhs. 2.5 lakhs. After incorporating these journal entries in the ledger, what could be the new balances in these assets and liabilities? You have to verify. So here share capital being 12.5 lakhs, CRR being 2.5, GR being 1 lakh and securities premium 1 lakh, total being 4.5 lakhs. So share capital being 12 lakhs 50, reserves and surplus being 4 lakhs 50 and current liabilities being, there is no any change, it remains same 10 lakhs. 10 lakhs, okay. No change in the asset side. Come on, total the liability side now as per the revised one. Retail 30 lakhs. It's now agreeing. It's now agreeing. Clear? It's one of the comprehensive illustration. Come on, make note of it. Form the format here. What's the format here? Redeemable preference share capital, premium payable on it. One is proceeds, another one is free resource to CRR. Entry 1 proceeds, entry 2 due entry, entry 3 payment entry, entry 4 adjustment of this loss, entry 5 is this one. Cross verification is for what? Face value of redeemable preference share capital should be equivalent to proceeds and CRR. For fund requirement, amount payable to the redeemable preference shareholders, and do you get any proceeds or issue of equity share capital, issue price of equity share capital and preference share, any bank balance we have can be used. After this, if there is any shortage, you can go for borrowing or issue the debenture or sell the asset or investment. At the time of issue of preference share, there was a redeemable premium of 5%. So as per the terms of issue of preference shares, these were redeemable at a premium of 5% on 1st February 2024. And it was decided to arrange this as far as possible out of company's resources, subject to leaving a balance of 50,000 in the credit of the profit or loss. So they want to use this one. Predominantly they want to use the CRR, but they need to maintain at least 50,000 in the profit and loss account. So in profit and loss account, they need to maintain how much? 50,000 rupees. They can use how much? 2.3 lakhs can be used. 2.3 lakhs can be used. Okay. Now what is the preference share capital? Value of preference share capital? 4 lakhs. Premium payable on this being 20. Okay. I assume this 20,000 rupees is adjusted in 2.3 lakhs in profit account. Right. So out of 2.3 lakhs, I can use 20,000 means still I have only 2 lakhs 10,000 rupees available in free resource can be transferable to the CRR. Securities premium is not the free resource. So only from profit and loss I can use 2 lakhs 30, but I have to retain at least 50. 230 can be used. Out of that, 20,000 rupees used for adjusting the loss and redemption. 20,000 has gone, so only 2 lakhs 10,000 is available in CRR. Out of 4 lakhs, 2 lakhs 10,000 is now the amount required for this purpose being 4 lakhs, but CRR being 2.1 lakhs and shortage being 1.1 1.9 lakhs. That 1.9 lakhs can be arranged by issuing shares. Now, it was also decided to raise the balance amount by issue of 17,000 equity shares of rupees 10 each at a premium of rupees 12 rupee 50 paise. Now what happens here? You can make it 19,000 shares. Rather than 17, you can make it 19,000 shares. So 19,000 shares at rupees 10 each. 1,90,000 rupees. Issue price being at 12 rupees 50 paise. So 2 rupees 50 paise. What is the value now? This is securities premium. 2.5 into 19,000. 47,500. Now process being 1.9 lakhs. They have given the information correctly. So 2 lakhs 10,000 is transferred from the free resource to CRR. And my requirement being 4 lakhs, out of 4 lakhs 2.1 is raised by CRR, shortage 1.9 can be issued by way of equity shares. The number of shares issued here being 19,000 shares at rupees 12.5. But profit is only 10 no. 19 into 10, 1,90,000 being the profits and another 47,500 being the profits. You are required to prepare the necessary journal entries. Okay. Current asset to be called as a bank. So we have sufficient money. How much we have to pay? We have to pay 4,20,000 rupees from the issue of equity share capital. How much I am getting? 2,37,500. Already we have the balance in current assets. We assume the bank balance exists, so we don't borrow or we don't sell the assets. Come on, pass journal entry. For the issue of equity share, journal entry being bank account debit to equity share capital account to securities premium. The value being 2,37,500. Equity share capital being 1,90,000 and 47,500 being the securities premium. And for the due, the entry being redeemable preference share capital account debit, premium on redemption account debit to redeemable preference shareholders. This value being 4 lakhs and this is 20,000. Overall value being 4,20,000 rupees. And payment to them being redeemable preference shareholders account debit to bank. The value being 4,20,000. And the loss 20,000 is adjusted where? In profit and loss account. So profit and loss account debit to premium on redemption. To premium on redemption. Value being 20,000. I have to create the CRR. For that the entry being P&L account debit to CRR, the value being 2,10,000. 2,10,000. Is that clear? Now I have to prepare the balance sheet. Redeemable preference share capital debit. Already we have credit balance gets cancelled. Premium on redemption debit. Credit got eliminated. Redeemable preference shareholders credit and debit got eliminated. In bank balance, we have 420 paid, 237,500 created. Come on, get me the value. I assume that the current assets being bank balance. We have 3 lakhs in the opening balance. By issuing the shares, equity share capital, I collected 2,37,500. I made a payment for redeemable preference shareholders 4,20,000. Then what is the balance I have now? 1,17,500. So the bank balance hereafter 1,17,500. Is that clear? Bank is now totally eliminated. P&L account debit, total debit value being 230. Already we have 280. By debiting 230, now we will have only 50,000 rupees. And equity share capital rises by 190. Already we have 2 lakhs, 190 is added, so 3 lakhs 90. Securities premium already we have 50, now another 47,500, so it becomes 97,500. Hope I have ticked all. So CRR, new reserve comes, which is around 2,10,000 rupees. Now the total of the balance sheet being, total of the balance sheet 9,57,500. Come on, get me the total in the library side. Are you getting the same answer or not? Nine lakhs 57,500. Clear? Okay. But in the book they have solved using the ledger format, not in journal entry. They open all the ledgers and solved, not journal entry. See the solution. See the solution. Okay. The premium on redemption adjust routed through equity share application issued. All these things are routed through ledger account. Remember, in the text they have given 17,000 because they consider securities premium can be used for adjusting these losses. Rather than P&L account, they have debited the securities premium in the text. It's a old format. Okay, currently for the CA foundation or CA, whatever it may be, they have to go this model only. Don't debit to securities premium. In case of loss, it can be debited directly to the P&L. Now, I am not going to solve the question number 5 here. What happens if there is any partly paid up shares? If you have fully paid up shares and partly paid up shares, if redemption is initiated, then you have to redeem this one. You should leave it unredeemed. If you have partly paid up shares and asked to redeem, convert that into fully paid up shares and then redeem. And then redeem. Is that okay? In this case, preference shares 1 lakh and calls in arrear 20 each. 1000 means for every share 20 rupees is the calls in arrear, so 50 share. Overall redeemable preference share 1000. Out of that, for 20 shares, calls in arrear is there, and remaining, 50 shares, calls in arrear is there, remaining 950 fully paid up. Fully paid up. If you are asked to redeem, what you can do? Read the question here and then plan accordingly. What is done here? Out of 50 shares, holders of 40 shares paid the call money before the date of redemption. So we collected. The balance 10 shares were forfeited for non-payment of calls before redemption. Forfeited shares were reissued as fully paid up. So what happens in this case? It is nothing but out of that redeem means forfeiture and reissue. Thereafter you can go for redeeming all the shares. Forfeiture also be mixed. Forfeiture also be mixed here. It's a rare scenario. But if you have the partly paid up share 1000 shares and fully paid up shares another 1000 shares, and asked to forfeit means redeem means you have to redeem only fully paid up shares. Okay, that additional information you have to understand. So now let's move on to the issue of bonus shares as well as right shares. Very small topic. Let's try to finish up that one now. Let's see. Now, what is the journal entry for the issue of bonus shares? Issue of bonus shares. Okay. So bonus share is nothing but free shares. So when you issue the free shares, you don't get the cash. Then what to be debited? Usually debit the P&L account to equity share capital. If you collect the money, bank account debit to equity share capital. But if you don't get the cash, the journal entry being P&L account debit to equity share capital. That's all. P&L account debit to equity share capital. Clear? P&L account debit to equity share capital. Okay. It is not only P&L account. You can use any free resource. Remember, in this case, it is not only free resource, you can use securities premium, even capital redemption reserve, even any other free resource also can be used to preference equity share, bonus to equity shareholders, and then bonus to equity shareholders to equity share capital. That's how you can pass two entries. Don't pass as a single entry. First entry is announcement of bonus share. Next entry is releasing the bonus share. Announcing the bonus share is nothing but reserve account debit to bonus to equity shareholders. That's the first entry. Second entry being bonus to equity shareholders to equity shareholders account, equity share capital. Here, we no need to use only the free resource. We can use a securities premium and capital redemption reserve created also. Right. See, if you have 10 rupees equity share capital, paid up 10 rupees. Means fully paid up equity share capital. Fully paid up equity share capital. For the fully paid up share, if you have one fully paid up shares, company will offer you free one more share. That is what about the issue of bonus shares for fully paid up bonus shares. Equity shares. If you are being the fully paid up equity shareholders, then you will be getting fully paid up bonus shares. That fully paid up bonus share will be given out of what? General reserve, securities premium, capital redemption reserve also. Clear? But which reserve cannot be used, Plan revaluation reserve cannot be used. What reserve cannot be used? Plan revaluation reserve cannot be used. See, in your balance sheet, you have plant and machinery 100. Today you revalue and found that the worth being 150. Rather than depreciation, it is revaluation profit. And revaluation profit will be appearing in the balance sheet liability side as 50. Is that okay? This is what about the appreciation of your assets. Depreciation usually you subtract and debit to the P&L account. In case of appreciation, add to the asset and show that as a revaluation profit in the liability side. This is also reserve only, Can I use it for bonus share distribution? No, sir, you cannot use. So, for fully paid up share, you can use a free resource, securities premium, including CRR. But what cannot be used? Plan revaluation reserve, because it is not in the form of cash. Clear? Step number 1. And in case of partly paid up shares, means 10 rupees share, but only 8 rupees is paid up. Remaining 2 rupees you have to pay, Meanwhile, with the 8 rupees, they operated the business, huge profit came. Rather than giving this as a dividend and collecting 2 rupees from you, the company now announced, don't pay the 2 rupees, it's free. I convert the partly paid up share into the fully paid up share without collecting the money from you. It is called, again, bonus issue of conversion from partly paid up to fully paid up. So, the journal entry being, what's that? Securities premium and securities premium, free resource account debit to equity share capital. And you can give in detail, what is that? Share call account. Bonus for the share call account, like this is named as bonus for share call account. And then this bonus will be debited and to equity share capital. Or you can pass routed through bonus, means call money. Due entry being share final call account debit to share capital. But we have to collect the final call. No, instead of collecting, I now use the free resource. Right here, you see. What is the journal entry for the due? 2 rupees collected. Share call account debit to share capital 2 rupees. But I am not going to collect it from you because the company is offering at free. The journal entry being general reserve or profit and loss, whatever it may be, profit and loss account debit to bonus to shareholders, 2 rupees. And this bonus is now collected, assumed to be collected for the share call. So, bonus to shareholders account debit to share call account, the value being 2 rupees. Is that okay? These are the 3 entries are passed. Call due entry 1, bonus due entry, bonus adjusting for the call money, 3 entries. But here, you can use only the free resource. What are the resources cannot be used? planned revaluation reserve, securities premium, CRR, all the three cannot be used. So for fully paid up bonus share, you can use what? All the reserve except revaluation reserve. For partly paid up shares, you can use only free resource. Is that clear? So what are the resources we have? Free resource, CRR and securities premium, even capital reserve. Okay. Then we have revaluation reserve, revaluation of asset for fully paid up bonus share. Bonus share, fully paid up. This can be used, this can be used, this can be used, this cannot be used. For converting the partly paid up share into fully paid up share, you can use only free resource, you cannot use this one and this one. Hope you will be now able to understand this. Clear? For this, what is the journal entry? What is journal entry? Free resource, CRR, securities premium account debit, to bonus to equity shareholders, and bonus to equity shareholders account debit to equity share capital. In this case, what is journal entry? You have to pass the share call account debit to equity share capital, and then free resource account debit to bonus to equity shareholders and bonus to equity shareholders account debit to equity share capital. Bonus to equity shareholders account debit to share call account. This may be equity share call account. Here what cannot be used? CRR and securities premium cannot be used. And revaluation profit cannot be used at all for any purpose. Cannot be used for any purpose. That's clear. Make note of it. Clear? Now, we'll start with the first illustration. Issue of bonus share related. The company wanted to issue bonus share to its shareholders at the rate of 1 share for every 2 share held. necessary regulations were passed, requisite legal requirements were complied with, you are required to give the effect of the proposed bonus issue. Come on, tell me. Now currently what we have? 7 rupees 50 paise for 10 rupees share. This is authorized capital. So you have to convert this first of all into fully paid up share. Okay, 7 rupees 50 paise share partly paid up. 10 rupees share, 7 rupees 50 paise is paid. So partly paid up share is converted into fully paid up share. 80,000 shares are there. So 80,000 into 2 rupees 50 paise will be the call money. What is the journal entry for the call money? Share call account debit to share capital. 2 rupees 50 paise into 80,000, 2 lakhs. Now I can raise this or first issue this as a bonus. Partly paid up is converted into fully paid up bonus share. Then fully paid up equity share or equivalent bonus share also be received. Okay. What are the things can be used here for converting the partly paid up share to fully paid up share? Capital redemption reserve cannot be used. Plant revaluation reserve cannot be used. Securities premium cannot be used. So predominantly use only the free resource. Only the free resource. In case of fully paid up bonus share, you can use the capital redemption reserve. Plant revaluation reserve cannot be used. Securities premium can be used. And general reserve can be used. Assume the development rebate reserve and investment allowance reserve may be for some specific purpose. In the case of specific purpose, the usage will be the least choice. Okay, development rebate reserve as well as investment allowance reserve. If it is being the free, you can use it as you wish. So give the last priority for that if you don't have any other options. Usually it cannot be used, right? Now, for this, I can use what? General reserve. For this, we have only one option, that GR can be used. So, GR account debit 2 lakhs, bonus to equity shareholders. Bonus to equity shareholders 2 lakhs. And bonus to equity shareholders account debit to share call. Now you converted the partly paid up into fully paid up. Partly paid up into fully paid up. First part is over. Now, bonus share issued. For how many? 1 share for every 1 share. How many shares are there? 80,000. So for 80,000, how many bonus shares are going to be issued? 80,000 bonus shares are going to be issued. We suppose to issue 80,000 bonus shares. Clear? Now for the bonus share, fully paid up bonus share, we can use non-usable resource. What are they? CRR, because these resources can be used only by this time. 1.5 lakhs can be used. 1.5 lakhs. And of course, we can use the securities premium. The value being 1,50,000, isn't it? 1,50,000. Here I missed. 1 share for every 2 shares held. 1 share for every 2 share held. Then how many shares are issued? 40,000 bonus shares. Make a correction. 40,000 bonus shares are issued. So securities premium being 1,50,000. Bonus to equity shareholders. How much is that? 40 into 10, 4 lakhs I will need. Shortage 1 lakh can be used from general reserve. Out of 3 lakhs already I used 2 lakhs. Another 1 lakh is still available. I need only 1 lakh. I can use the general reserve here. Now this bonus will be converted into equity share capital. Bonus to equity shareholders is converted into equity share capital. The value being 4 lakhs. Clear? Now incorporate those things in your balance sheet. Equity share capital, already we have 6 lakhs, with that 2 lakhs is added, 8 lakhs, and okay, 8 lakhs, another 4 lakhs is added, so the value being 12 lakhs. Share call, debit credit got eliminated, bonus to equity shareholders, debit credit eliminated, GR 2 lakhs and 1 lakh in debit side makes the GR being 0, and CRR 1 lakh 50, already we have 1 lakh 50, gets eliminated. Securities premium, already we have 1 lakh 50, now got eliminated. Always cross verify whether the authorized capital is higher than the what? Issued capital. Else you have to change the authorized capital. After the bonus issue, if the issued capital becomes 16 lakhs, first duty you have to increase the authorized capital, whether stated or not, because your issued capital could not be more than the authorized capital as per the legal requirement. First, to increase the authorized capital beyond the issued capital. Give a note of that. So here, of course, authorized capital is less than what? The issued capital, don't do any more adjustments. Capital redemption reserve 0, plant revaluation reserve 20, securities premium is 0, development rebate reserve 2 lakhs 30, investment allowance reserve 2 lakhs 50, and capital reserve is 0. Non-current liabilities and other things not required available here. Come on, total this. 17 lakhs now gets tallied. Hope you'll be now able to understand how to issue the bonus share. Fully paid up bonus share as well as conversion of the partly paid up into the fully paid up. What other things can be used also be explained in detail here. Clear? Come on, make a note of it. We'll now deal with right issue of shares or further issue or follow-on public offer. Okay. If the company issues shares subsequently, already the shares are traded in the market. If further issue is given, usually no, market price may be 150. If the company wants to raise further, the new issue price may be further issue price. Okay. Maybe 120 or 130, much cheaper. Then there will be huge demand. The market price is 150, further issue is 120, means there is a huge demand. So automatically there will be a competition. In order to avoid the competition, the further issue is offered to the existing shareholders. To whom? Existing shareholders. If the existing shareholders are not taking, then it may be taken by the third party. Clear? Hope you'll be now able to understand. That's why it is called right share. Means existing shareholders are having the right to purchase the new issue first time. If they don't say I don't want, if they say I don't want, then others can purchase. Right. See here. The right issue will be offered to whom? Existing shareholders. Existing shareholders only. Existing shareholders. At much discounted value. What they can do? They can simply sell the shares, buy the share. Market price being 150, but right share price is 120. If you want to purchase a company share, you have to pay 150 rupees. If you are purchasing from the same company, because of your right to purchase, you can purchase it at for 120. You can buy paying at rupees 120. This is one option. One more option, sir, I don't have 120 rupees to purchase, sir. What can I do? I can divert this to third party. Okay. That is called renouncing the right. Renouncing the right. Renounce this to some third party, probably X. And for that renouncing means I am transferring my right to third party. Sir, I have the coupon, right coupon. It may be assumed to be a coupon. If you have the coupon, you can purchase the price at discounted value. 150, if you have the coupon, you can purchase for 120. As I have the right coupon, I can purchase it for 120, but I don't have 120 rupees. What can I do? I can give the coupon to somebody else. He can go and purchase. No. That concept is called renouncing the right share. While renouncing, the transferring the coupon is not at free. Give me some pricing. So he demands, give me 30 rupees, sir. Now X gets the right from this shareholder for a price of 30 rupees. And X can purchase it from the company by paying 120 rupees. Okay, you can either purchase it directly by paying 120 or renounce your right to third party by getting a small amount which is called right price 30 rupees. X can purchase the right, means the coupon for 30 rupees and now pays 120 for purchasing the share. This process is called renouncing the right. Or simply take no action. Taking no action is foolish, because if you are renouncing, you will be getting 30 rupees. If you don't take any action, you will be losing that 30 rupees also. Three types of questions may be expected. One is calculation of value for the right. Okay, another one being, this is called as prior to the right issue value. Next you have to calculate what is the X right price. After the issue of the right, what could be the value of the share is called X right price. You have to calculate the X right price. Third step, you have to pass journal entry for the right issue. Journal entry for the right issue is nothing but issue of shares, like that's just the same bank account debit to equity share capital. That's how you can pass the entry. So you have to calculate these two additionally. Now let's see. We try to solve this illustration. Okay. Now, Pioneer Limited has issued 15,000 equity share of rupees 10 each. The current market price is 37. Current market price being 37. The company has a plan to make a right issue of one new equity share at a price of 25 for every 5 shares. Right issue price being 25. But you are eligible for purchasing one share for every 5 share held. For every 5 share held, you will be eligible for purchasing one share. So, if you want to purchase it from market, you have to pay 37 rupees. If you want to execute the right, you can purchase it at 25 rupees. You will be enjoying 12 rupees benefit. You are required to calculate the theoretical post-right price per share. Okay. You have to find out the post-right price. That's a one calculation. Second one being theoretical post value of the right alone, right value. These two you have to calculate. Third and fourth not required for the foundation level. So you have to find out these two answers. Now, shares held for right eligibility. How many shares you have to hold? 5 shares hold. And right shares purchased. So if you hold 5 share, how many right shares you will be able to purchase? 1 share. To hold 5 share, how much you have to pay? Currently you have to pay 37 rupees as per the market value. This is number of shares, this is rupees per share. If you hold 5 shares which is traded in the market 37, you will be eligible for purchasing 1 share at what rate? 25. Now what about the total value? 185. This is 25. Now how many shares you have? You have 6 shares purchased at what rate? 210. Okay, 210. Is that clear? Now what about the per share value? You divide by this. This is called theoretical post right price. Theoretical post right price. Is that clear? So how can you value? Two things are valuable. One is all about what? Theoretical post right price. How can you find out the theoretical post-right price? Share held for right eligibility first at the market price, then share acquired due to execution of right at the right price. Now add up the value and add up the number of shares. 210 is the overall amount you paid for procuring 6 share, means what is the amount you are paying per share? 35. 35. Is that clear? Now, what about the right value? Right value. Right value. For a right value is the difference between, this is called as cum right value. This is called X right value. That's how you can name it. The difference between cum right value and X right value. X right value divided by number of right shares. Number of right shares. This is the formula. 37 is the cum right value, 35 is the X right value, number of right share being 1, so 1 rupee is, so 2 rupees will be the right share, right value, 2 rupees will be the right value. If the company announces the right share to the existing shareholders, what will they do? They can buy. Buy means the shareholder gives 35 rupees, 25 rupees and get the share. Buy the share. Or renounce. Renounce means simply this shareholder gives it to X for rupees, 2 rupees. Per share he transfers 2 rupees per right. Per share 2 rupees. If X wants to buy one right share, how many rights he need to have? 5 rights he needs to have. How many shares? Unless he holds 5 shares, 5 rights he is not eligible to get 1 share. For every 5 rights he will get 1 share. So for every right I transfer it for 2 rupees means X purchases how many rights? 5 rights for 10 rupees. 5 rights at the rate of rupees 2 means 10 rupees. And then X will give this right and 25 rupees to get the share. Now for X, what is the cost? 2 into 5, 10 rupees and 25 rupees is paid for purchasing the share, 35 rupees. So X purchases share for rupees 35. He purchases the coupon, right? How many rights he need to purchase? 5 rights he needs to have to purchase 1 share. For every right he has to pay 2 rupees. For 5 rights he pays 10 rupees. Apart from that, giving the right, he can purchase a share from the company at 25 rupees. If you have the right, you will be able to purchase the share for 25. So 25 plus 10, 35 rupees you have to pay. Hope you will be now able to understand. So what are the 2 calculations you have to do? One is all about determination of value for right. Next one is all about execution of right. Means post right and pre right. X right and post right. Okay. And third one being the journal entry. So we have calculated 2 aspects here. One is we calculated the X right price and cum right price, and second one being the company is planning to raise funds by making rights issue of equity shares of finance its expansion. The existing equity share capital of the company is 50 lakhs. The market value of its share being 42. Market value is 42. The company offers to its shareholders the right to buy 2 shares for 11 each for every 5 shares held. Now shares held. How many shares you need to hold? 5 shares. If you hold 5 shares, what could be the right shares you will be eligible? 2 shares. So if you are being the holder of 5 shares, you will be eligible for getting 2 right shares. Now for this holding the share, how much you have to pay? 42 rupees. For purchasing right share, how much you have to pay? Only 11 rupees. Rupees per share. Now what about the total rupees? 210, 22. Am I right? 232 will be the value for 7 share. And what about the value after the right share? 142. So 33.142 is nothing but X right price. This is called X right price. Now how can you find out the value? Right value? Right value is equal to, okay, cum right price or cumulative right price minus X right price. X right price divided by number of shares. Number of shares. Number of right shares. So 42 minus 33.142 divided by 2. Come on, get me the value. 4.43. 4.43. Clear? Now, if you want to purchase this company share, how many rights you need to have? 5 rights you need to have. 4.43 into 5 right shares, value being how much? Come on. 22.14 something. Okay, 15. So you have to pay 22.15 to get 5 rights to purchase 1 share. If you have 5 rights, you can purchase a new share for how much? Only 11 rupees. The overall amount paid being 33.15, which is equal to the X right price. Always you can cross verify. Always you can cross verify. So theoretical right price, value of right also calculated. Percentage increase in share capital. What is the increase in share capital? 2 right share issued for every 5 shares means 40% increase is there. From the existing number of shares, now you increase 40% shares. Earlier 5 share means hereafter you have 7 share. How many, what's the percentage of increase in share now you have? 40% increase is there. Fourth one being, you have to pass a journal entry. Journal entry is very simple. What's that? Bank account debit to equity share capital to securities premium. Okay. Currently, how many shares you have? 5 lakh shares you have. Right shares being 2 lakhs. So 2 lakh shares, per share you collect 11 rupees, 22 lakhs. What about the face value? 10 rupees, 20 lakhs. Additional 1 rupee collected will be called as securities premium, 2 lakhs. This is what about the journal entry. Is that clear? In text, I have passed 2 entries. I have clubbed here to pass as a single entry. Clear? So, in case of debenture redemption, remember, if you have unlisted companies, not being financial institutions or bank, forget about the listed company. If it is being the unlisted company, not that company's shares or debentures traded in the stock market, is called unlisted company. If it is being the unlisted company, whatever the debentures outstanding you have, okay, for that extent you have to create the DRR. Okay, DRR should be created. Apart from that, you have to invest at the rate of 15% over this. 15% will be invested, debenture redemption investment. There you learned capital redemption reserve. Here we are going to use the term DRR, debenture redemption reserve. Okay, you have to create the DRR and investment 10% of the value of the outstanding debenture is issued. Whatever the debenture issued, if you issue 10 lakhs, DRR should be 1 lakh. And invest debenture redemption investment an amount equal to 15% of the nominal value of the debenture. If it is being 10 lakhs, your DRR should be invested in DRRI being debenture redemption reserve investment being 1.5 lakhs. This is the only aspect you have to cover. Rest will be very easy. Okay. Question number 4. I'll discuss this. The balance sheet of SSA Company Limited being unlisted company other than AFI and banking company, non-banking financial corporation, housing financial corporations. Okay. Other than these companies, banking companies. How much debentures we have? 1,20,000 rupees. At the annual general meeting, it was resolved to repay the debenture at a premium of 3%. At the premium means 3,600. So 1,23,600 you have to repay. If you supposed to redeem, what you have to do? You have to create DRR. Not only creation, you have to invest that in the DRRI fund. How much DRR should be created? 10% of the nominal value, which is 12,000 rupees. How much DRRI should be there? 15% on this. 15% on this being 18,000. Rest will be the as usual case. Rest will be the as usual case. This is before redemption. Before redemption. After redemption, not required. So this can be transferable to the GR account. DRRI can be withdrawn into the cash. You can withdraw into the cash for redemption purpose. These two extra points. Redemption already we studied. In the case of issue of debenture, we learned the redemption also, right? The last illustration, 7th illustration we solved in DR, means debenture interest, no, issue of debenture. While redemption, what do you do? Okay, debenture account debit to bank. If you are paying extra money, that is called redemption of debenture account debit. Premium on redemption of debenture account debit to bank. That's how we pass the entry for the redemption. That's very simple. Before that, you have to pass these two journal entries. Rest of the things are same. So redemption at 3%. 1,20,000 means you have to pay 1,23,600. What is journal entry? 12% debenture account debit, premium on redemption on debenture to bank. How much is that? 1,23,600. 1,20,000 here, 3,600 here. Is that clear? C. DRR created by debiting to the P&L account similar to CRR. Investment made at the rate of 15%. Debenture redemption reserve investment account debit to bank. And debenture redemption 12% debenture premium payable on redemption to debenture holders also be passed. Once the redemption is confirmed, the loss on redemption can be adjusted in the P&L account. Once redemption is over, the DRR not required, investment not required. Okay. So the debenture redemption reserve not required is transferred to GR. Debenture redemption reserve investment also not required can be encashed and settle the money to the bank debenture holders. So only these items you have to remember. What are the 3 items you have to remember? In addition to the things what we learned already, before the redemption, you have to create the DRR at the rate of 10% of the nominal value from the P&L account. After redemption, the DRR is transferred to the GR. And you invest that after the redemption, you can withdraw. This is one entry, second entry, third entry is the redemption, fourth entry being you can withdraw, and fifth entry being transfer this. These are the entries. 4 entries additionally you have to learn here. Beyond that, nothing is there. Everything we learned already. The same will be applicable here also. Is that okay? This model is enough for the foundation level. Inter also, I think, recently these models are prescribed. Other models are not required. But anyhow, you can better have the overview of all the models for the CMA Inter Group 2. Still they depend on the old formats. In CNO, they prescribe this format predominantly. Clear?